Hi there, it's Brad Flynn again, looking at some of the business fundamentals that we need to be considering as we start to grow your business. Today we're going to be looking at something that's critical in your business called the break-even analysis. Now it's a simple formula that helps you in your decision-making process as we begin to grow your business. And as the name suggests, it tells you what you have to do in terms of a sales output to actually break even. In other words, to cover the cost of what you've invested. Now, we also use it in terms of different areas of your business that I'm going to come to after I've explained to you what it's all about. But fundamentally, let's take a quick look at the formula and how we apply it. Pretty simple. The break-even figure in any instance is basically whatever the expense or the investment is that you're making divided by the gross profit percentage of your business. Now in the profit and loss statement video, we look at the GP and how to calculate it and what it means. So if you're not real sure about what that is for your business, go back and take a look at the profit and loss business video, and then you'll be able to go forward with this one. So break even given by the expense divided by the gross profit percentage. So let's say in your business that you wanted to do some advertising and you weren't sure whether it was going to be worth the investment or not. Now advertising is a bit of a bugbear of mine, I guess, in businesses, because most business owners do what I call spray and pray. They get approached by the local newspaper or some other type of advertising medium, or they'll go out and seek them themselves, and they'll buy this advertising piece praying that it's going to solve all their problems. Bus advertising would have to be one of the worst. In fact, I'm yet to find someone who can make bus advertising work, and I'll tell you a bit of an example about that in the numbers in a minute. So, in this instance, let's put some numbers in to see how it stacks up. So let's say that we're going to invest $1,000. We're going to run an advertising campaign in the local newspaper. Now, for us to work out what amount of sales this advertising must generate to cover the cost of that advertising, we can divide it by the GP. So in this instance, I've picked an example of 50%. You would need to look at your profit and loss statement to understand this for yourselves. So $1,000 divided by 50% or 0.5 gives you $2,000. So if we were going to make this investment in advertising in the paper or wherever it is, for us to break even and get our money back, in other words, the marketing becomes an investment, not an expense, it would need to generate $2,000 worth of sales. Depending on your business, let's say that you had a business that had an average dollar sale amount of $100. Then what we would do is take that $2,000, divide it by 100, and we would know that we would have to achieve 20 sales from that particular advertising campaign. Now, if you've got all your testing and measuring in place up until now, you'll have a good idea whether that's going to be a good idea or not to make that investment, rather than just praying and spraying and hopefully that'll work. We're going to get to in the coaching program later on how to write effective advertising. But for now, all we want to do is understand how many sales we would need to break even on that investment. At the start of this video, I mentioned that we're going to look at some of the other areas that we might be able to apply a break-even analysis. So, first of all, profits. If we were to look at your business and we know what the fixed expenses are and we want to make a certain profit target, we simply add the two together and then divide it by the gross profit percentage for that business, and that will tell us what level of sales we would need to achieve that year to meet our profit target while meeting our overhead expense. Kind of handy, isn't it? If you want to set the baseline profit target first and then work your way up, which is the opposite to the way most business owners do it. Secondly, marketing. We've just looked at an example for newspaper advertising. This could be for anything, whether it's vehicle signage, internet sites, cinema advertising, which is probably one of the worst ones I've ever come across, or the bus advertising. Now, to give you an example of the bus advertising, I worked once with a client who was a hairdresser, and she was spending about $1,000 a month on this big flash bus advertising scheme. To her credit, what she had been doing was asking all of her clients how they'd heard about her. So what we did was actually work out how much it was costing her to get one of those clients to contact her business and when they became a full-time client. So when we did the numbers, $1,000 a month, and I think she was getting on average something like 2 leads per month from this bus advertising, we worked out that it was costing her $550 to get one of these people to come to her business via the bus advertising. Now, given that her average sale was somewhere around $80, that meant that she had to get that person to come back 4 or 5 times, do the math quickly, 6, 8, it's between 6 and 7 times before she covered the cost of the bus investment. Very expensive way to actually buy customers, and in the coaching program we're going to look at that as well as find you the most effective ways that's at low cost to get you good quality customers. Within your team, what about if you want to put on a new salesman? Same thing. If their sales, commission or base structure, whatever it is, let's say we're going to pay them a $50,000 base salary for the year, and if we use our GP example of 50%, 50,000 divided by 50% would be $100,000 in sales. Now, once you know the numbers in your business, you're able to make a good estimation of whether you think the market has got that capability and whether the person's going to be able to achieve that target or not. So you can make a better decision on whether to go ahead with hiring them or not. And the last one down here is assets, machinery and equipment. So if you're going to buy a new widget maker for $10,000 and we know that your break even is 50%, so we know that that widget maker has to improve efficiencies by 20 grand. So is it going to speed up the throughput through your premises to make sure that you are able to meet that payback target? And how long is it going to take before the additional throughput that this machine is making covers the cost of its investment? If it was going to take an extra 10 years to pay it off, then there's no way you'd go for it, of course. But if it was going to repay itself within a couple of months, well then great, because once it's paid for itself, everything beyond that point, you get to keep a percentage of. Now this is an interesting point. You don't get to keep the whole amount, you get to keep the gross profit percentage. So if you're making $1,000 above the break even, what happens there is your gross profit, if it's 50%, so half of that $1,000 will go straight to your bottom line. The other half will cover the cost of goods sold. So if you go back to the profit and loss, that might make more sense for you. So there you have it, break-even analysis, a very handy tool to use in your business on all sorts of different levels. Hopefully by now you've got a better understanding of that, and when we catch up in the next coaching session, we're going to work out where we need to apply that in your business to maximise the results. Thanks for watching. I'm Brad Flynn.
Look at them yo-yos, that's the way you do it. You play the guitar on the MTV, that ain't working.